The 7 companies making up what are commonly called the Magnificent Seven are clearly perhaps the 7 best companies in the world, and they have been the 7 best investments you could have ever wanted to make. But are they good investments now? Watch this video and find out. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. A lot of times I do videos where I feature a stock that I consider to be undervalued or attractive for whether it's for income or growth or total return or whatever. But in this video, I'm going to do something a little different. I'm going to review 7 stocks that are known as the Magnificent Seven, and we all know who they are. And I'll be showing those here in a second in the portfolio. And they clearly are great businesses, every one of them. And they're mega caps. They've become, because they're such good business, they've all become very large enterprises. And they've been great investments in the past. But are they good investments now? Let's turn to the Fast Graphs Fundamentals Analyzer software tool. And let's evaluate these companies. And let's look at what caused them to be such good investments in the past, and why they may not be such great investments in the future, even though they still remain some of the best companies on the planet. Let's go ahead and go into Fast Graphs. Here we have the portfolio. I built a portfolio called the Magnificent Seven, or I shortened it to Mag 7. The 7 stocks, of course, are Apple, Amazon, Google, Meta, or Facebook as it's more commonly known, Microsoft, Nvidia, and Tesla. These 7 companies are really great companies. Now, first of all, they all are investment-grade companies. They have AA ratings, AA plus for Apple, AA for Amazon, AA plus for Google, AA minus for Meta, AAA for Microsoft, one of only 2 in the world, and AA minus for Nvidia. Tesla is rated BBB, which is still investment grade, but it is the lowest rated stock of the group. Now, if we look at the companies from a standpoint of what sector they're in, I do want you to note that if I organize this by sector, 2 are in the communication services sector, 2 are considered consumer discretionary, and 3 are considered information technologies. For sub-industries, it's interactive media and services, that's Alphabet and Facebook. Broadline retail, of course, is Amazon. Automobile manufacturer is Tesla, which is a lot more than an automobile manufacturer, by the way. Semiconductor company would be Nvidia. Apple is technology, hardware, storage, and peripherals. And then Microsoft would be called system software. I would argue, actually, if you really think about it, that all 7 of these companies are really in information technology, even though they're technically classified by the GICS code, the General Industry Classification Code, as the sectors that I've just mentioned already. Now, when we look at year-to-date price return, as you can see, they've all had pretty good price returns for this year alone, except for Tesla. Google has had a year-to-date return of over 35%, Facebook over 49%, almost 50%, Amazon over 31%, Nvidia has had an extraordinary 165% year-to-date return, and Apple is grown by almost 19%, and Microsoft by 22%. Now let's also look at their last trailing month price returns, and you'll see that, let's go ahead and put these in order of highest to lowest. Nvidia has more than doubled in the last year, the last 12 months. Facebook is up over 80%, Google 58%, Amazon 53%, Microsoft 36%, Apple 19%, and Tesla is actually down 4.41% for the year. And then, of course, you can see their quarterly returns have also been stellar in some of the companies, but there's a few like Amazon and Microsoft, as well as Meta, that haven't really been gigantic performers for the quarter. Okay, and we're going to examine all that as we go into these. Now, as usual, I'm going to look at these companies in alphabetical order because it's just easier to follow and keep track of where I'm at when I do that. But what I'm going to do is I'm going to look at these companies from 2 perspectives. So let's go ahead and start with Apple. Now, the first perspective I'm going to look at the operating histories of the company. Now, clearly, long-term, Apple has been a very consistent and very powerful growth stock, averaging just under 40% a year annualized growth. And this goes back to their fiscal year starting in September of 2003. All right, now they've had tremendous growth, and you can see some of these numbers have been astronomical. All right, but let's shorten the time frame a little bit. Let's drop this to 20 years, take a year or two off, and now we see the growth rate is 25%. This is very important because this is already a company that's $3.5 trillion in market cap, which is absolutely beyond almost human comprehensive huge. Now, let's go ahead and put weekly closing prices on the graph, and let's back it up to the maximum level because I want you to see this. This really explains why the company's performance has been good. If you look at the performance over this time frame, again, going back to October of 2003 through July of 2024, a simple $10,000 investment in this company would have grown to $5.9 million, and you'd have received dividends of $212,000 alone. Unbelievable, a 36.2% annualized rate of return. And the stock market had a very good couple of decades here itself. This is the S&P 500, averaging almost 9%. Okay, the dividend growth rate has been astronomical at just under 40%, and the compound growth rate has been around 23%. So as we look at this stock from a performance point of view, Apple has been an incredible performer over these couple of decade period of time here. But I also want to point something else out. There were times when Apple was not commanding much of a valuation. For example, if we look here, we see the blue line on this graph is a PE of 24. These are reference lines. The orange line is a PE of 30, where we cap it out on the fast graph tool, we don't put a PE above 30 as a reference line. We just feel that that's getting a little bit aggressive, obviously. The company currently trades at a 35.26 PE ratio, and it has an earnings yield of under 3%. That means if you bought Apple today and Apple gave you 100% of all the profit they made as a dividend, not just the normal dividend that they're paying here, which is about 15% of their earnings, if they paid you 100% of their earnings, your yield would only be 2.84%. As it is, the dividend yield is 0.44% because of the extremely high valuation. And I also want to point out, this is the highest valuation that Apple sold at during this entire period. You can see that because it's so far above the orange line, which is a PE of 30. But I also want to point out that Apple also was a time when it was trading at multiples that were more rational, 14 and 15 multiples back in 2015 and so on. And Apple started paying a dividend in 2012, and they've had a tremendous dividend record, as I showed you earlier, and the dividend has increased, but they still pay out hardly any of their earnings. But now let's do something else here. Let's shorten this to an 18-year time frame and watch what happens to the growth rate. The growth rate now has fallen to less than 23%. Let's drop this to 15 years, and the growth rate has dropped to less than 15%. All right, so growth is slowing down dramatically for this AA+ rated company with a $3.5 trillion market cap. And I do want you to notice that the stock was trading more or less between 15 and 18 times earnings. That's the blue line and the orange line on this graph. Routinely for all these years until we came into just before COVID, which was 2020, where it really got into about a 26 multiple. And then coming out of COVID, during COVID, it crashed like most stocks did temporarily. And then we've had this super run up, and Apple has been a very highly valued stock. But I want you to notice something here. I want people to understand when I say, is it a good investment going forward? Well, it's been a tremendous investment in the past. There's no question about that. All right. But the stock, if you look at a period like if you looked at December of 2021 and held it through January of 2023, approximately 2 years, you'd have actually lost approximately 1 year, a little over 1 year. You'd have lost over 20% of your money. That was a very bad year. On the other hand, if you'd have bought it in January of 2023 and held it till roughly December of 2023, again, approximately 1 year, not exactly, you'd have made over 57% annualized, turned $10,000 into $15,000, and generated a 56% annualized rate of return without dividends, 57% when you include dividends. Okay, but then that was followed. So my point is there's a lot of volatility here. Now the question is, as we shorten the time frame some more, we see the growth rate has dropped a little bit. I drop it to the last 7 years. It's actually inched up a little bit, but I get rid of this high year here and look at the most recent years, and we start seeing growth of about 6%, 7%, with expectations of 9% and 10% growth going forward. So therefore, if I go to the forecasting graph, you see that the analysts are forecasting about 9.5%, 9.45% growth. And that would actually indicate a company that's growing at 9.45% would indicate a 15 PE as a fair value multiple. Now, the market multiple for the stock over the last 5 years has been 23.68. But even if it traded at that normal multiple, that's what this is called a forecasting calculator, okay? And if you look at the calculations here, if Apple were to grow by fully 7.5% this year, earn 659 this year, which is the estimate, and if they earn 721 next year and then 793 the following year with almost a 10% increase, if the stock traded at a 23 multiple, then you'd be looking at a rate of return of a loss of roughly 8% per annum. Now, even if it traded at its current multiple, its very high multiple, you would only stand to make 10%. So in other words, a 10% rate of return is attractive, but my point being is that you're taking an awful lot of risk to earn that when you're facing the potential to lose 7 or 8% of your money. Now, Apple would have been a better purchase if you look at the stock from a historical perspective, and we'll just go back, like we'll do 12 years, so we're looking at about the last decade plus estimate data here. You could have bought Apple plenty of times here for something around 15 times earnings or even less. Even if you would have been paying 18 or 19 times earnings, you'd have been making a pretty sound investment. I'm just going to argue that this is clearly still a great business. There's no arguing that. There's no question about that. The problem is price is what you pay, value is what you get, as Warren Buffett so aptly taught us and warned us, really. Buying Apple today doesn't make a lot of sense. Should you sell it if you bought it? The stock has momentum. You're probably facing some short-term drawdowns on this stock, I would guess, going forward. But the point is, it's a great business, and it's actually performed extremely well, and it's had a great dividend record going forward as far as dividend growth. But we're now looking at Apple at a very, very high valuation. Amazon, in contrast, I've always liked to look at Amazon, as I've done in previous videos, by looking at operating cash flow rather than earnings. Jeff Bezos was purposely not trying to generate a lot of profit, but just a lot of cash flow. And as a result, the market, as you can see, has really correlated this stock price with its cash flow very closely at around a 25-ish multiple historically. Okay, it's currently trading at a blended price to cash flow of 20 times cash flow, and which is technically low relative to the company's historical norm. Now, the growth rate, like we saw with Apple, is beginning to slow down. This is a $2 trillion company, AA rated with only 36% debt, but we're starting to see the growth is slowing down, although it's still growing at a double-digit rate. If I drop this down for the last 7 years, we see growth of about 23%, and the growth of the cash flow is still expected to be strong going forward. So if we look at forecasting here, the growth expectations is to maintain about a 23% growth rate. So using the P equals growth rate formula, that would argue that Amazon could be undervalued at a PE or a price to cash flow below the company's expected growth rate. And you could stand to do very well, make 25 or 30% gains. So Amazon may clearly still be a very, very good investment even at these levels today. It's historically been a great investment, as we can see here. We'll go ahead and do the max, and we'll just run the performance. And by the way, when I look at these performance, I want to remind you the beauty of what Fast Graphs does. We're looking at price change and cumulative comparison, and we see operating cash flow growth of 29%, price growth of 23%, which means that the price has not really grown as fast as the cash flow. And if we look at the stock market in contrast, it's had a compound annual growth rate in price of 8% over this time frame, 8.16, and the cash flow growth has been about 5.5. And we clearly see something else here about valuation. We see Amazon being very highly valued back here in the beginning versus the S&P being lowly valued. But what we also see is that the growth rate of the cash flows has been significantly stronger. From a pure perspective, performance perspective, Amazon has produced a 23.5% annualized rate of return for its shareholders over time with no dividends. And again, the market's done about 8.87 over this time frame. So this has been a tremendous performer, turning $10,000 into over 700,000, 768,000 over this time frame. It's really been a terrific investment from that point of view. Now, if we move on to Google and we look at Google also from an adjusted operating basis, we see that Google's stock price has really tracked its earnings. Now, there were times when it was trading at normal PE ratios below its growth rate. Again, the orange line on this graph is a PE ratio of 30. If I point to the orange graph, I get a 30 PE. The blue line is 29.75, and so they're basically superimposed. It's the same number, if you will. In this case, the orange and blue line, looking at it from the max point. But once again, as I shorten the time frame, let's just go ahead for sake of brevity, jump to 15 years. Now we say that growth has dropped almost in half to 17%. And if I run it even for the last 10 years, which includes 2.5 years of forecasting, we're sitting at 18%. But the market is still valuing it at a 25 multiple. So looking at Alphabet going forward from a forecasting point of view, it's still expected to grow at double-digit rates, but you're paying a very high valuation to buy that. If you put the normal multiple on here, this might make a decent amount of sense to be able to give you double-digit rates of return. But I do want to point out, you're taking a pretty big gamble there. Your earnings yield's only 3.5%. Your dividend yield is 0.4%, and your PE ratio is over 28.19. So Alphabet is still growing very nicely. It's been one of the strongest businesses on the planet. Again, it's AAA plus rated. It's a $2.34 trillion business. And that alone should tell you that it's going to get harder and harder for companies like Apple and Amazon and Alphabet to continue to grow at very, very fast rates. But they're still defying gravity. They're still growing very fast. They're superb businesses. The question is, price is what you pay, value is what you get. Are you willing to pay these premium valuations to buy it? Now, I think Alphabet might make some sense still today in the market, given the fact that it's still expected to grow pretty fast. And even with growth close to what it's expected to grow at right now, it's still commanded a 25 or 26 multiple. All right, now I want you to notice at different time frames, these numbers change because you're measuring growth rates over different periods of time. That's what makes FastGraph such a great tool. You can analyze all these different time frames and what happens to the company's operating results and how the price reacts to those changes in operating results. The next company on the list, of course, is, I have trouble not calling it Facebook, but Meta Platforms. And as you can see, the growth has been very consistent and really spectacular at over 30%. And the stock price has tracked that very clearly. When they did have a down year in 2022, they had a 38% drop in earnings. You saw a subsequent drop in the stock price of actually 69%, which was a great overreaction. And that turned it into a value stock at that point. It had a tremendous value. If you'd have bought it at the bottom here, if you were lucky enough to do that, you'd have done over 168% October of 2022 to currently to July here of 2024. So buying low and sell high is the great principle of investing, obviously, the number one rule. Now, as we go forward, growth rate is beginning to slow down, but valuation, again, is sitting at virtually an all-time high. We're looking at a PE of over 30. Now, it's traded close to that PE in the past, as you can see, and of course, but that led to a drop in earnings, then a drop in valuation. So assuming earnings continue to hold up, not really sure what's going to happen to Facebook, but looking at it, growth going forward, expected to grow at 18%. If it traded at a PE equal to its growth rate of 17.9, you'd have a 3.79% return. If it traded at its normal multiple, which is 23, you'd be able to earn about 6.5%. And my point is that the odds of generating really high returns buying the stocks here, any of these 7 stocks here, with the exception perhaps of Amazon, would be very, very iffy. You'd be taking a lot of risk for a lot less potential rate of return than you would customarily expect from these kind of companies. Now, the next stock on the list is the mighty Microsoft, the AAA rated company with only 21% debt. And here's what I think is interesting about Microsoft. Now, you can see that starting in 2016, this company has really deviated from anything resembling fair value. But we also had a surge in growth during this time. So you can almost understand why people got hyped. It was a 12% grower long term. More recently, it's been over a 19% grower. Okay, and then that gave people to put a premium valuation on the stock. But I think you should also recognize that if I use my scroll bar function here and kind of go back into different periods of time and look at the stock, it was 11% grower there, but it was only a 7% grower here. And there were lots of times during this era where the stock was trading at around a 15 multiple. Here's a 15 multiple and on the blue line, and you can see it was a little higher than that coming into the recession of 08 and 09, but then it got down to a 9 multiple, and we had 10 and single-digit multiples all through 2012 and 2013. I remember doing videos on Microsoft back here, and people were saying that I was crazy. This stock was a dinosaur. Jeffrey Balmer, I think, around that time was still the CEO. He was horrible and no good, and the stock was terrible. Well, it was a great buy from a value point of view back then, even given the growth that it actually achieved, which wasn't that great. You can see it only grew by 3% in fiscal year 2012, grew by a negative 7% in 2013, 2% in 14, 0%, and then 6% in 16, until it started growing at double-digit rates again, starting in 2017. And that's when the stock really began to take off and get the high valuations it currently has. The problem is the horse has already left the barn. You're paying a very, very high multiple to buy a stock that is going to grow at double-digit rates. I really believe it's capable of doing this, especially with the AI commitment they have. But I think you're taking a big risk buying the stock at this level. Microsoft is still one of the greatest companies on the planet, but it's also one of the highest in terms of valuation, trading at just under 40 times earnings. And let's put that into perspective. You're paying 38.9 times this year's earnings to buy the stock, or another way of saying that, you're paying 39 years approximately of earnings in advance. Or another way to say that is, it's the price you're paying. You're paying almost $40 to buy just $1 worth of Microsoft's earnings. Great company, maybe the best of the best. You could even argue that. But the point is, it's sure trading at a premium valuation. Now, Nvidia is an interesting stock to look at. Let's look at it historically like we did some of the others. If I use the scroll bar back here, Nvidia was a pretty strong growth stock going from 2005 through 2020 even. And it had this period where it had this surge in growth in 2017 and 18. But that led to this very significant drop in price, especially when the earnings began to falter. But then, as you can see, the earnings began to grow again, and the stock rallied very strongly until it fell dramatically again. And these roller coaster ride type stock performances are something that a lot of investors simply aren't emotionally capable of dealing with. I can tell you that from firsthand experience. But the company has produced and is producing tremendous growth going forward, but that growth is also beginning to level off, if you will, but still average over 35% a year. But once again, you've got to pay a PE ratio of 69.3, blended PE ratio, to buy the stock. And even at a 30 multiple, the stock would actually lose money if you held it for the next 2.5 years. Even at its normal multiple of 48, you'd still be looking at making double-digit returns, about 18%, but you would be making double-digit returns. But it doesn't mean that the stock won't drop significantly in between growing over the long run. But could you buy Nvidia today? Perhaps, if you held it long enough or were willing to hold it long enough, and also if you were willing to make a commitment to investing in the stock. And if it did drop in value again, like we saw it, what happened here in 2022. But that would be a big if. The next stock, of course, is Tesla. Now, Tesla has been such a crazy stock. I'm going to take the normal PE off. I want you to notice that Tesla didn't make any money at all up through 2019. If I scroll back here and look at their earnings growth, it was 8%, but that's really a misnomer. And so the normal multiple was 5,000, and that's not even real, because there were times here when the stock was making losses. It's just almost impossible to graph this company. But then as they started generating a profit, notice how the stock price came right back down to their profit, but it was still trading at a 30 multiple here. But there were times that it was trading at these very, very high multiples. And of course, here you're getting astronomical multiples because there were no earnings, all right? But my point being is very difficult to graph. But again, if I kind of close this gap a little bit, let's get rid of some of that anomalous stuff, we see that the company has been recently growing at about 28% a year, and the market hype got it really up to a PE of over 170. That brought the stock crashing down. The drop from here to here, the volatility is what I want you to focus on here. This was a 70% loss. And then that 70% loss, if you'd have bought it at the very bottom, if you'd have been smart or lucky enough to do that, over the next year or so, you would have seen about 135% gain and obviously been very happy. But if you'd have bought it here and held it even to today where it's rallying again, your gain would have been about 63% a year annualized over the last couple of years, and that's with earnings not doing so well. The point is, buying the stock at 100 times earnings, and I, like a lot of people, I don't believe this is a car company. It's got a lot more going on than automobiles, although they call it an automobile manufacturer. By the way, that's become a real tough business for not just Tesla, but every manufacturer making electric cars. Just Google it, check it out, look at Wall Street Journal. There's Teslas and other electric cars that aren't selling, and the used car market is absolutely turned upside down. So there's a lot of issues going on with the stock, and it's still expected to grow at almost 19% a year. But you're looking at buying this stock at an absurd valuation. The real difference in Tesla compared to any of the other stocks we've looked at here so far is that there were periods where the company really didn't make any money for investors at all. There's from April of 2014 to April of 19, that's called a 5-year period, made 3% a year holding Tesla. All the money was made really starting from around April or May of 2019 and then peaking up here at 2021. Let's just calculate that real quick. I just pick a spot here. And you're looking at making a growth of 2,000%, an annualized rate of return of 245%. Think about that. You'd have turned $10,000 into $250,000 over just a very, very short couple of years here. But then, of course, then if you would not have been, let's say, lucky enough or smart enough to sell it there, then you'd have watched that money you made drop by almost 70%, as I showed you earlier. And now we're dealing with this volatility. So this is not a stock for the faint of heart. Now, it's a great business. Take the price off of the chart and look at it strictly from a standpoint of operating earnings. It's now starting to make some really good money. It's forecast to still get pretty decent growth, although we're expecting a down year in 2024. But Tesla is really one that will test your mettle. Price is what you pay. Value is what you get. So the real purpose of this video today was to look at these magnificent 7 stocks from a standpoint of what kind of business they have been in the past, but also how the market has priced the business, and more importantly, how it's pricing it today. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, kind of just giving you a look at a review of the Magnificent 7. There are a lot of lessons on valuation in analyzing these 7 stocks. And again, I think every one of these stocks are terrific companies. But as investors, it's incumbent upon us to make a distinction between what's a great business and a great investment. Sometimes the two don't match. Oftentimes they do, but sometimes they don't. And usually it's because valuation gets in the way. So measuring performance without simultaneously measuring valuation is a job half done. And that's why I like fast graphs so much. It lets you invest with your eyes wide open, and you can see what the valuations have historically been and what to expect going forward in the future and what leading analysts are thinking. But the key is invest in the business, but try to buy the business when you can own it at a price that makes prudent and reasonable sense, where you got value for your money, in other words. Thanks for watching. If you like the video, give me a like, ring the bell, and take a look at subscribing to our channel, and take a look at subscribing to Fast Graphs. And by the way, I want to be clear as I end this video. I'm not recommending these stocks or saying you shouldn't buy them. I'm simply trying to give you a picture of the realities of what the price looks like relative to the company's fundamentals in the current market environment. These stocks have been responsible for almost half of the S&P 500's market value and performance over the last several years. And that kind of concentration is really tough. So anyway, invest your money wisely and carefully, and look for value whenever you can find it, and quality whenever you can find it. Thanks for watching.